Hello. Welcome to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Well, it happened again, folks. We got another futures sell-off in the month of September. Where last video was a bit of a learning module, today we'll do a market assessment. We'll look around and check out the damage. We'll make sure that the underlying supply hasn't changed its tune, and I'll give you my thoughts on what to look for in the coming days and weeks. If you're enjoying the content, give this video a thumbs up. Make sure you subscribe and turn on that bell icon so you get notified when I post new videos. I'm enjoying making this content, and your support means a lot for the growth of this channel. So let's get started. We can see here on September 7th we had a pretty dramatic flush that was well documented, and in a previous video we broke it down. On September 20th, on Monday, we got a similar event. So what happened there? The place we will start looking is on futures open interest. So this is the total USD volume of all open futures contracts on the perpetual side of the futures market. There are two futures markets. One of them has expiring contracts, and one of them has a perpetual contract that doesn't expire and uses a funding rate mechanism to govern the balance in the system. We went through all of this in detail in a previous video, and I'll leave the link below if you want to understand more about how the futures market can affect price. So this observation that I'm going to point out here was first brought to my attention by Checkmate, the lead analyst at Glassnode, and he pointed it out in the Week on Chain video report. When we got this big flush on September 7th, it happened very quickly. It was a cascading liquidation event, where each trader that got liquidated, their closed out position triggered someone else's stop loss, and it created a domino effect. All of that was over with in a couple of hours, and the bottom got bought up pretty heavily. It put us in a sideways chop action, and it almost looked like we were climbing out of that rally about a week after. But here on September 20th, on Monday of this week, we saw another deleveraging event. But this one was a bit different. Whereas the flush on September 7th, you can see, was a dramatic decrease in a very quick amount of time. What happened on the 20th was more of an orderly closing out of positions. It was not a cascading liquidation event. There wasn't a large amount of long liquidations, which is what would be shown here. Long traders are those who take a bet for price to increase, and when they're wrong, their positions get closed out. So those positions did not see a high amount of liquidations, especially compared to the 7th. It was more, I guess, a voluntary closeout of positions, more so than what happened earlier this month. Let's take a look at the futures crash here on the hourly chart for Bitcoin. If we look over here on September 7th, look at how few candles were involved in this massive correction of, 18 total percent. This happened over a period of a couple of hours. There was a bit of a sell-off in the morning, and then the actual liquidation occurred over 2 one-hour candles. That is a very quick amount of time for price to lose, $10,000 almost. But if you look over here on September 7th, this event was much more orderly. There were a couple of liquidations, a couple of quick flashes, but this is much more orderly, much less chaotic, much less dramatic, but it results in the same kind of deleveraging and the same amount of fear in the market. And in my estimation, it seems an effect of the Evergrande uncertainty and the unserviceable debt situation in China, on top of other macro factors, inflation concerns, supply chain squeeze, all of those things that are going on in the economy, big picture, seem to be playing a role in what we saw on Monday. Traders looking to de-risk and take a step out of the market until more certainty can be had. This commonly happens in markets, especially in the speculative side, so it doesn't give me great concern about the overall outlook for Bitcoin and the market, as long as we're seeing the supply dynamics that we've been watching the last few weeks continue their trend. Let's look into that. What we'll look at next are the spent volume age bands. We've talked about this chart quite a bit on this channel, so you may already understand how this works, but essentially it's the relative volume spent on chain every day grouped by the age of those coins. The younger coins are at the top in lighter colors, and older coins are at the bottom in darker colors. If I go back over here to late fall 2020, you can see in the bull run what older coin volume looks like. There are these dark bursts of volume down here in the reds and purples and dark oranges that signify older coins being sold into market strength, realizing gains in a bull run. This is what it can look like. It can take, 10 or 15% of the daily volume on a given day. You can see the axis right here. And something I want to point out also is that younger coins, coins that are only a 1 hour or 24 hours old, they consistently take up a large portion of daily volume, at least 50% of it on most days. And that is pretty normal. That's a product of speculation, day traders, all that stuff. Those coins, they churn around constantly and they never really get a chance to age. So there's a certain portion of the coin economy that stays hot, that stays active, and never really sees an age more than a day or two, maybe a week. So that volume is ever present. And what you can notice over here in the summer, after we started accumulating here post sell-off, we really started seeing younger coin volume start taking more and more of the relative daily volume settled on chain. The dark colors down here, while you still see little pockets, are diminished. They aren't taking up as much of the daily volume. And there's even these momentary spikes. I'll zoom in. There's even these momentary spikes where there's almost no old coin volume at all. That's when you see this light yellow really press down into these lower values. This is more of the daily volume being taken up by young coins. Here on this day, on August 1st, 87% of all volume on that day was from 1 hour coins. So the reason for this, it doesn't mean that there's suddenly a lot more speculative volume in the market. The reason this is happening is because there is less and less old coin volume. The folks who are sitting on coins for 6 months or more, which in this chart is what we would consider old coins, those folks are not moving their stash. They're just sitting dormant. And so as less and less of that volume realizes itself day to day, then more and more of the relative volume is taken up by younger coins. It's a percentage game. And so what this is saying over here in the most recent part of price action is, yes, there have been a couple of moments where we've seen some old coins come to life. Here was the sell-off on May 7th that we talked about. El Salvador makes Bitcoin legal tender on this day. It's a big flush. And we see a few old coins come to life here. They got nervous. Time to get out. That's expected. And you see a little bit of that activity here. But again, on this day, on this flush day, most of the volume was taken up by younger coins. 98% of the volume on this day was from coins less than a week old. 99% of the volume were from coins bought after June 20th. So the only people that are moving any coins on a day when we have a second futures sell-off in the same month, the only people who decided to move coins that day, by and large, are market entrants that showed up in June or later, or day traders who are always present in the market. The long-term players, the hodlers, the sat stackers, the illiquid supply, the strong hands, those people have not come to life and they don't see any reason to sell here. Let's just think about this from a human psychology perspective. Some of the people now who have 6-month and older coins, those folks bought in March. So their entrance to the market was over here. And they bought essentially the top of Bitcoin. So not only did they buy the top of Bitcoin, but they then held through this massive liquidation here. Another big sell-off, the Elon tweet about Tesla not taking Bitcoin, a huge, gargantuan liquidation event that occurred on May 19th. And then 3 months of just sideways crab market chop and accumulation. They put up with all of this and they didn't sell. So why would they sell here? It's a legitimate question. What would be their motivation to leave the market now after weathering all of this with a cost basis up here near 60K? They don't have a reason to sell. That's why they're not. And so when we have these events like this, when we have these days where price just plummets and it's because of futures, it's always important to think about the market psychology of the other people sitting on this asset. Do they have a motivation to leave? Is that motivation stronger than the motivation to HODL, to stay strong and to ride it out? Have they been given a reason to stop believing in Bitcoin? Have the rules of Bitcoin changed in any way? If those questions can be answered confidently with a no, then our assumption can be that those classes of investor are not going to be riled by a brief flash in price. This is the dormancy chart. We haven't looked at this before, but it helps to emphasize the point I was just making about coin age. Dormancy is the average age per coin transacted each day on chain. You can see in the fall during the bull run, dormancy was accelerating. We're looking at it here with a moving median because this value chops around quite a bit. So we're looking at the median in order to really gain the trend. During a bull run, dormancy accelerates. Older coins at an increasing rate are sold to new hands. They come to life. Their coin days, their age, is destroyed upon sale, and that is what raises this dormancy value. It's the average age of these coins being sold. And so that is increasing as older coins are realized at a greater rate. And finally, you reach this apex. And this moment here is the one we've broken down quite a bit. This is the 40K rally and pullback in January that really signified the top of the market for the hodlers. This was where all of the on-chain signatures showed the true end of a blow-off bull run. And the rest of this rally was kind of a mixed bag of factors that we've talked about at length. And you can see dormancy here really, it plummeted heavily, and it's found a bit of a sideways action during this kind of stalled rally in the spring, but has been in a downtrend since. A steady, not dramatic, but consistent downtrend of age. And this is showing you the decreasing activity of older coins as time goes by. Hodlers are not interested in realizing profit or loss at this point in the price. Their biases have not been changed. Their market outlook has not changed. This signature is indicative of accumulation. Older coins are being moved at a slower rate. Younger and younger coins are taking over the daily activity on chain. That's what dormancy is representing here. The next thing I want to look at helps tell this story on a bigger picture, and it's also a really cool chart that I've been waiting for an opportunity to show, so this seems like a good one. This is the realized cap HODL waves. So we have two versions of these HODL waves charts, and both of them represent the distribution of supply through different lenses. The standard HODL waves chart that we are not looking at right now shows the distribution of the total Bitcoin supply by the age of every coin. The realized cap HODL waves is the same perspective, but it's showing the coins based on the date they were last realized on chain, the last time that they had value realized. So what that does is natively ignores coins that have never moved. So the supply, for example, that sits with Satoshi Nakamoto, the 1.1 million coins that he mined 10 years ago and has never moved, don't show up here in the realized cap HODL waves. The same goes for newly mined coins that have not been moved. This is only showing the age of coins realized on-chain every day by the age at the time of realization. So this gives you a truer representation of the age and volume of coins that transition between hands through market cycles. The older coins are at the top in cooler colors. Younger coins are at the bottom in warmer colors. As coins age on the realized cap HODL waves, they graduate from lower bands up to higher bands. And when older coins are spent, they leave the higher bands and join the bottom group at 24 hours. So you get a swell of activity down at the bottom of the chart when older coins are spent out of the upper bands. If you look here in the bull run of 2020, the upper groups began to taper right as price was breaking the previous all-time high and stretching up to 40K. Right here in November and December into January, you can note these groups up at the top. This is the 2 to 3 year group. This is the 1 to 2 year group. This is the 6 month, 12 month group. This is the 3 to 6 month group. And you can see right here at this moment, this is where they start to taper and the volume at the bottom begins to swell. This is showing you older coins being realized and joining the younger groups to begin aging anew. As these coins age, if they're not sold again to rejoin the 24-hour group, then as each of these thresholds are broken, coins will move up into the next group. So what you get in a distribution pattern when we're not in a bull run, when price has rolled over and the majority of participants on chain are in accumulation, you start to see swelling of the older bands. Note how the younger coin volume begins to taper down until July here. It's decelerating, and as it's decelerating, these groups above it are beginning to grow. As the 1 day to 1 week and 1 week to 1 month cohorts begin to shrink, the 1 month to 3 month group is getting larger. And at this point, here in March and April, the 1 to 3 month group bought from February back to January. So you're capturing people who bought in this area and decided not to sell, and their coins are now maturing into the 3 to 6 month group. And as time goes on, we get into the summer, these coins begin graduating into the 6 to 12 month group. Here, you can really see the belling out of this group into the summer months. And this is showing that a large percentage of supply was accumulated back here that has not been relinquished. And then, to take it one more step, this group here, this is the 6 to 12 month group. These are the folks that have held for half a year to a year, and this group is belling out dramatically. Flatlined up here because this group really absorbed most of the action from the past year, so it makes sense that we haven't seen a huge distribution up into the groups above this just yet. But in a matter of time, in a few months, if price continues to stay steady and we don't have another dramatic event, we might start seeing more maturation up into these higher groups. But for now, 6 to 12 is really seeing growth. If I turn off some of these younger ones, I bet we'll get a good idea of what that looks like. This is now showing only coins 6 months and older. And you can see the distribution really began in earnest in March, and it has continued. And the growth from this group, this is the 3 to 6 month group, you can see here that they start losing supply, but that supply isn't being spent. It's graduating into the older group. So this is really showing you the accumulative behavior that is occurring on chain and the size of it. It's a large portion of supply. So what we'll be looking for on the realized cap HODL waves going forward is for another swelling of these younger bands. And if so, we'll need to look up into the higher groups to see where that supply is leaving. You'll see like a compressing behavior up here, the way we saw back in January. And when you see that compression, it will manifest itself as a swell in the lower, younger groups. Because when a coin is spent, its lifespan starts over at 0, and it becomes a 1-hour coin, and then a 24-hour coin, and then a 1-week coin, etc. So that was an introduction to the realized cap HODL waves, and it shows you the distribution pattern we've been seeing this year. The last on-chain chart I want to look at today is illiquid supply shock. This has been one of the more common charts we've looked at on this channel because it has been very relevant this year. And there's something going on with it today that I've noticed that is worth talking about. So we spoke in the first video, I'll leave a link in the description, about illiquid supply shock and the types of investors that it represents. Illiquid supply, this blue line, represents entities, that is individuals on chain, who have sold less than 25% of their Bitcoin lifetime. These are hodlers. These are people who do not sell, they mostly stack, and we can trust that when they acquire new portions of supply, it is highly likely that they will sit on most or all of it long term. What we noticed after the sell-off in May, price capitulated, so did illiquid supply. These are strong hands letting go of coins and their share of supply shrinking. This is a normal market pattern. But we noticed that when price finally found its bottom, I mean, it wasn't the true bottom of the market, but this sideways movement is just accumulation. When we finally finished the sell-off, illiquid supply began growing while price continued to decline. And this is what we call a bullish divergence, where underlying supply is telling a different story from a negative story in the price. It's telling us that there are market forces moving underneath the surface that are operating counter to negative price action. And this kind of behavior over a period of weeks or months, as we saw here in the summer, can ultimately lead to price appreciation by way of a supply squeeze. Circulating supply is being taken offline into the hands of users who do not like to sell. Many of these folks employ cold storage solutions. Their coins are not on exchanges, their coins are held in self-custody, and they aren't being sold. And what we can see here We've been in a price decline for most of September. Here's the September 7th pull. Here's the September 7th sell-off. Here's the September 20th sell-off. Illiquid supply has been on the increase. We have another bullish divergence in illiquid supply against a depreciating price. That gives me confidence that we may, in the short term, continue to see a strong floor of support for Bitcoin. If we think back to the summer here, there were moments where price dipped below 30,000. And on virtually every one of those instances, it was heavily bought up. Strong-handed investors stepped in, they saw a price that was too good to ignore, and they bought price out of the 20s and back over 30K. This was occurring throughout the summer months while we had this bullish divergence in a liquid supply shock. If we start seeing additional weakness in the coming days or weeks, and we continue seeing illiquid supply shock increasing, we may get a similar effect to what we saw here at the end of July when price really started to jump. Now, it's important to remember that in the short term, the price can always be affected by factors outside of on-chain analytics. Speculators in the futures market, macro FUD, macro doubt, economic factors outside of Bitcoin, large whales pulling trickery in the order book, all of those things could happen and do happen occasionally to affect price in the short term. But what is most important are the people who set the floor for Bitcoin and what point they feel price is too low to ignore. That is what matters. And so that is why we watch supply dynamics so closely, because that will tell us the true story of where Bitcoin is going over the next 2 months, next quarter, next half a year. And that is the perspective that most interests me as a long-term investor in this asset. So keep an eye on illiquid supply shock. So, with all that said, it's important to remain in a healthy mindset about Bitcoin. The rules of the protocol have not changed. The confidence in the hodler base has not changed, and the behavior of spenders on chain remains within historical norms. There is price weakness, there are people realizing losses, and this can be an emotional time for investors. So there's nothing wrong with having caution and wanting to know what's going on. But I implore you not to make emotional decisions and to make sure that you're fully informed before taking action. Make sure you follow me on Twitter at TXMCTrades. I post regular analysis and observations, and many things that don't end up making it into the videos. If any surprises come our way, I may make a shorter video to give you an update on those things. I hope that you continue to find value in these videos, and I thank you for all of your support. Take care of yourself, friends, take care of each other, and we'll speak again soon. Cheers.